Good morning, everybody. That's the one song I can play once a year, right around the beginning of the year. Happy New Year to you all. It's January 4th, 2024. It's our first daily bites of 2024. So it's great to be with all of you today. Hope you had a nice, long, restful weekend and a safe one for New Year's. Just to let you know, my name is Bob Lang, and we do the daily bites every Monday and Thursday, roughly around 8:30, 8:45 in the morning. Kind of talk about what happened with markets recently, what's happening now, and then what we can probably expect a little bit down the road. So, as all of you know, the markets have got off to the new year to a shaky start. It actually started last Friday, which is the last day of the year. Markets did come down about 0.5% roughly, and continued to slide on Tuesday and yesterday, trying to get it back a little bit today. It looks like the Nasdaq is down about 60 points so far. SP futures have been bouncing around between positive and negative all morning here. So we're down about 1 point here. The Dow Industrials up about 80. That's been the stronger index of the last couple of days, although it is down a bit for the year so far. Nasdaq down about 2.6% so far in 2024. Russell 2000 about the same amount as well. So again, off to a rough start. Yesterday, of course, was the last day of the Santa Claus rally indicator. Remember, it's just an indicator. It doesn't necessarily tell you that the market has to rally and go up during this 7-day period. Remember, it started on December 22nd, which was the first day of the indicator, and it ended yesterday. It's 7 trading days, the last 5 of the calendar year in 2023, and then the first two trading days of the new year, and that ended yesterday. It was down close to 1%. Now, as far as these calendar anecdotes are concerned, listen, I don't use those, but there's a lot of people who do, so we have to recognize them and acknowledge them and understand that people trade off of these things. So, excuse my coughing, just getting over a cold here. So, the next one up is the first 5 days of January, and oftentimes how the first 5 days of January goes, so goes the rest of the month of January, and then how the month of January goes, so goes the rest of the year. That's the thought process. Excuse me. So far, first 2 days of January, down, right? We'll see if we snap back a little bit today or even tomorrow. Don't forget, tomorrow is the big jobs report. It's the December non-farm payroll report. They're looking for still a strong labor report coming in for December and to finish out the year in a big way here. So I'm looking for inflationary numbers. Of course, right now, as we see the markets, they're a little bit oversold in the short term. In the long term, we were pretty overbought a couple of weeks ago, and we're back down to somewhat sort of a neutral state right now. The 20-day moving average is the important area to take a look at now. I want to show you a couple of charts here. Let's take a look at the S&P on the daily chart for a second. And you can see, let's slide that over here right now for you. So you can see here that we came in yesterday and tested that 20-day moving average, right? That's common when markets correct or pull back. And we pulled back about a couple of percent from highs of about roughly 47.85 or 47.90 last week. We pulled back a few days over here, and we'll see if that 20-day moving average is enough to stop the bleeding here. If not, then we're looking at some lower numbers down, even all the way far down to the 50-day moving average. Now, look, it's not going to happen in 2 days or 3 days. Highly unlikely. That's a lot of movement. That's 170 handles or 170 points on the S&P 500. Again, probably not going to happen in a couple of days, especially with the VIX down at 14%. But we could certainly see a move at least down to this good support area. Let's call it 45.50. I was looking at more of a 4,500 level, and that's coming into view if we break that 4,550 level on the downside. And again, we are a little bit oversold here on the short term, and you can see on the oscillators we broke 100 last week, and then of course we broke through the zero line, and now we're mildly oversold here, minus 84 and minus 106. So we'll see what happens later on today and into tomorrow. I've been emphasizing for everybody to hold some protection, and I've been talking about it since last week and into Tuesday endlessly. You got to have some puts on, got to have some protection on in this market, right? And maybe it didn't work last month, maybe it didn't work in November, but you always have some protection just in case you run into a buzzsaw of selling and that you didn't expect, right? Nobody rings the bell at the top, and nobody's going to call and tell you, hey, I'm starting to sell. You might want to get out ahead of me. Nobody does that. So again, let's take a look at this S&P 500 chart. Now let's take a look at it from a monthly standpoint. We didn't get together on Monday. Obviously, Monday was a holiday, was for New Year. So this is our first one of the new year, and we always like to take a look at the monthly S&P 500 chart to see where we stand. Are we bullish or are we bearish? And clearly, with the MACD crossing over a couple of months ago, we tested in October and didn't quite get there. That red line, we are still in bull mode here, right? So, and we do. If you even wanted to mark up the chart here, you can see a nice channel of higher highs and higher lows right there, and we could certainly make a step up there towards that 4,800 level, maybe 5,000. I was looking at some estimates for targets of the S&P 500 in 2024. Most people are pretty shy about it. I mean, the most aggressive one that I've seen was about 5,200 or 5,250. That would be about roughly a 10% move up for the year from current levels. We'll have to see what happens, right? Because these are two strong bars for the monthly charts for November and December. Two very, very strong candles here. Again, we could retrace back a bit. It would not be a surprise. We could pull back to about the 4,500 level, which is a number that I mentioned earlier, and still be in an uptrend, right? With the S&P 500 chart, and I'll show it to you right here. The daily chart we pull down to 4,500 here. We still have higher lows in place, right? But how is it going to feel if the S&P 500 drops 3%, 3.5% from here down to that 4,500 level? If you're long positioned and you don't have any protection on, how's it going to feel? It's going to feel nasty. It's going to feel bad because you're going to lose money on your short-term trades, especially with trading options like we do. So I encourage all of you, take some risk off the table, have some protection, raise your cash levels up to levels that you're comfortable with, right? Because like yesterday, we did pull back towards that 4,700 level, and we closed right at 4,704, and it looks like we're gonna open up right around that 4,700 level, maybe slightly below it today. So something you gotta pay attention to. You can't buy into the market fever even when the momentum is strong. You just got to pay attention to what's happening from one day to the next, right? And be able to be ready to shift gears to go, to add some protection, to be bearish or to be bullish or whatever, right? This is how we have to play this market these days, right? That's just what it is. So if you're not protecting yourself, and I put this note out for people, you're taking unnecessary risk. And that is a sure way of you're looking to lose your wealth over a short period of time, because the market goes down fast. It's unforgiving. when it's going down. And if you just want to wait things out, fine. But if you're an options player, again, you're going to lose a lot of value in a short period of time. And the markets have already gone up a lot. And so there are a million excuses, a million reasons for people to sell in the new year. Only one reason to buy. Markets are going to go up. Million reasons to sell, right? Okay. Let's see, what are we looking at here? I want to show you the Fed funds futures now. According to the Fed funds futures, you can see here, it's interesting. This is the next meeting in January. The markets are not looking for any move from the Fed in January, 93% that we're going to stay at 5.25. But you go out to the middle of the year, say July, the fifth meeting of the year, the fifth one of 8. And the markets are kind of looking at 4.25 to 4.5%, which would be 4 rate cuts, roughly 3.5 to 4 rate cuts by July. So you're talking, if no rate cut here, you're talking about at least 2 or 3 coming in between these 4 meetings here. Then you go all the way out to November, and you can see we're all the way down to 4%. So we're talking 5 rate cuts, and even there's a chance of a 6 over here. And then you go out to December. December is looking at 6 rate cuts, down to 3.75 to 4%, and we're currently at 5.25 to 5.5%. That is a lot of cutting, and the Fed really didn't indicate that they're willing to be that aggressive on the rate cut front. So is the market getting it wrong? Is the Fed going to chase the market's tail here and say, okay, well, we'll catch up to you eventually? I don't know. I guess we got to really pay attention to the data. I don't know if the market is really accurate here right now in interpreting what the data is going to look like down the road, right? We like to say that the market is rarely ever wrong, but certainly they're being very aggressive here. The market is very aggressive here, and we saw stocks rising in November and December on the back of this aggressive look at rate cuts by the market, right? A lot of people think that the Fed pays more attention to what the market is saying than what they than what they're saying. I disagree with that. They pay more attention to what they're doing and paying attention to the data, and whatever the market decides to do, well, so be it, right? And if the markets get slammed because the Fed continues to take a hawkish stance, well, that's just the way it is, and the Fed will move accordingly. So that's that for that. Basically, we're taking things a little bit slow here in 2024. I was looking at the healthcare sector. We've been doing pretty well. We did really well with Amgen, and we have some Johnson & Johnson as well. This healthcare ETF had a huge day on Tuesday, and it tried to follow through on Wednesday. May get a little bit of a boost today because of Lilly. Some Lilly news came out earlier today. But I like this. I like this group. I do think it's a little bit overbought right now, but it may pull back a bit. But there were certain names in this group like Merck and Amgen and a few others, Lilly, of course, that could help drive this group, these stocks, this sector much higher. It doesn't always have to be the FANG names. It could also be this sector here. Now, of course, earnings are going to start trickling in next week. We have a lot of the banks are going to be reporting next Thursday and Friday, and then the following week as well, a few more banks. We'll have a holiday coming up again on January 15th, Martin Luther King Day, and so we'll see what happens next week. And again, first 5 days of January, that will wrap up next Monday. So it's Tuesday, Wednesday, Thursday, Friday this week, and then Monday. Will markets turn it around and be a positive for the first 5 days? I don't know. We're already down. Let's see here. Here's the results for the explosive options, by the way. We're already off to a great start. We're up 2.5% in the year. The S&P is down 2.73. The S&P would have to recover close to 100 handles just to get back to that's the Nasdaq. Excuse me. I'm sorry. The S&P is down 1.39. The S&P would have to recover about roughly 60 handles, 60 points, just to get back to even, and above that for the first 5 days to work as well. So it's going to be an interesting year. I'm glad you guys all are with me. We'll be doing these daily bites twice a week. I have the market blast every single day. Chart of the week every Wednesday, and if you're in the chat room, it's great to have you there. We had an incredible turnout for our sweepstakes. We had 7 winners in our sweepstakes. We had one winner who Ernie, who won a whole year of the service for Total Access. We had another fellow, Bharat, who won 6 months. And we had 5 other winners who won a whole month of Total Access. They're in the chat room now. They're in the EO service, and they're also in the directional service, and they're also in the spread trader. So we're happy to have all these new people in here. We hope a lot of you out there will join us as well. We had a great year in 2023, up 36%. The S&P 500 was only up 24. So, you make the choice. Did you do better than the S&P 500? We did. We beat it by 50%. Did you do that? Did you do that well? If you didn't, think about it for a little bit. Think about why you didn't do well. Were you doing things wrong? Did you need do you need to change some things around in 2024? I teach a lot of stuff out in the chat room, out in social media, out on webinars. We're going to be doing a lot of webinars in 2024. First one coming up is the Leaps webinar, which is coming up at the end of the year, end of the month. That's always the most popular one. It's really going to be very exciting to share some of my thoughts from 2023 and then into 2024. And so we have a lot to cover, a lot of ground to cover as we go. But I hope you guys will be coming along with me, with us, and in 2024, and learning a lot, making a little bit of money along the way, and being happy about it. So, wishing you guys all a great trading day. Have a great weekend, and thank you again for spending a little time with me. And we'll see you guys all on Monday morning. All right. There's a little bit more YouTube before you start your trading day. Take care, everyone. Bye.